For more on the Fed's latest decision on rate cuts and the path ahead, let's welcome in now Esther George, former Federal Reserve Bank of Kansas City CEO and President. Esther, great to see you. So we have the Fed decision. Esther, curious to get your response. Was it the right decision, Esther?
Well, it feels like the right decision to me, and I think it is completely consistent with how the Fed has been talking about the risk that they face right now. So holding on that interest rate seems not only expected, but I think appropriate at this stage.
And Esther, one of the interesting through lines has been the patience that the Fed is bringing to this process. But of course, the conditions in the economy have allowed them to be patient, have they not? What would have to change and how significantly for a little more urgency to come into the fore here?
Well, I think you're exactly right. And remember, the playbook the Fed has seen before in this realm came in 2019, when tariffs were also the narrative at the time. And what has changed, of course, is that at that time, the Fed was not struggling with inflation. We were operating with inflation below the Fed's target. And so the ability to take a risk management approach allowed the Fed to be preemptive, if you will. That is certainly not the case today. And I think the amount of uncertainty is greater. Certainly the magnitude of the tariffs being considered a lot more dramatic. So it gives the Fed much less flexibility in looking ahead to an outlook or a forecast. They really have to watch the data right now.
And I'm curious, Esther, what's the economic data you're watching most closely right now? What's on your screen?
So, the thing that I spent a lot of time with as a Fed president and continue to watch today is, what do you hear in real time from businesses, from people that are actually making decisions in the economy? And I think the Federal Reserve's Beige Book gave you some clues to that. Some parts of the economy doing okay, others being very concerned. And so I think right now that uncertainty has permeated every contact that I talk to, and is causing them to really step back and pause on any decisions about investment, spending, or even households thinking about purchases they might be wanting to make.
Esther, of course, we have to ask you about Fed independence, too. Jay Powell has been very firm in his stance that the Fed is an independent organization, of course. President Trump has kept up his rhetoric. I guess at what point, though, how does the Fed be careful to not be pushing too hard against what the president wants because of wanting that appearance of remaining independent?
Yeah, it's one of the most important issues, I think, right now, Julie, is that I'm not concerned that in their deliberations, they are wrestling with this issue of independence. They are really focused on what allows them to achieve their mandate in a way that benefits the public interest. But of course, when this criticism is very public, they are quite aware that in their communications and in their rationale for actions they take, it will readily be viewed through the lens of some of these criticisms. So I think it just adds a layer of complexity to the very hard work they already have to do. It certainly, I think, with this current set of governors and Fed presidents, is not going to sway, though, their decision on what is right for the economy in their judgment.
Esther, I'm curious for you. I mean, how many cuts would you expect in 2025? And what do you think the timeline could be?
I think prior to April 2nd, it seemed that if inflation was going to cooperate, you would have the ability to move those rates down a bit more. But I think in today's setting, we're going to have to see a few more months to know whether the anticipated weakening is severe enough to calibrate 2, 3, 4 cuts, or whether the economy, in what we traditionally call a stagflationary sense, is able to continue to grow slowly, keep the unemployment rate at a level that allows the Fed to calibrate those in a smoother fashion. And so there is so much yet to see in the data that I think will help inform the Fed's decision. And of course, you see that in their statement today. Their statement highlights both of those issues. employment and inflation as being their big risk. Employment to the upside and inflation continuing to be an issue.
Do you think that it's also still too early to call whether there is going to be a recession as a result of all of this?
I do. And the reason I think so is because although there are clearly signs of weakening, the magnitude of that weakening will be very important to understand where it hits the economy. And so right now, I think the Fed has to be less forecast dependent, as some call it, and be more data dependent to see how this begins to unfold and what the magnitude of this weakness ultimately is.
Esther George, always great to catch up with you. Thank you so much.
Thank you.